Welcome to the deep dive. We take your research, your notes, all that information you've gathered, and we basically give you the shortcut to understanding it all.
Yeah, boiling it down.
Exactly. And today we're digging into something really interesting, a way of thinking about building wealth that, honestly, it flips the script on what we usually hear.
We're talking about Dhandho investing.
Right, Dhandho. And this idea that maybe, just maybe, massive success doesn't come from those huge, crazy risks everyone talks about.
That's the mission today, really. We want to kind of debunk this myth, this idea that you need to be some kind of daredevil, betting everything to make it big, whether in business or investing.
Because the story we always get is the high roller, right? The founder who risked it all. But, when you actually look at people like Bill Gates or Sam Walton, Richard Branson, the sources we looked at suggest something totally different.
Totally different. They were, it seems, masters of avoiding risk, or at least minimizing it dramatically.
So not high risk, high return.
No, quite the opposite. They were laser focused on finding opportunities that were, low risk, but still offered massive upside. They were actively looking for what some people call free lunches.
Free lunches. Situations where you can't really lose much, but you could potentially win big.
Precisely. Situations where the downside is capped, protected, but the upside is, theoretically unlimited. They just weren't interested in taking big chances if they didn't absolutely have to.
Okay, let's start with the name itself. Dhandho, what exactly does that mean?
Well, it's a Gujarati word. On the surface, it just means business or endeavors, but culturally carries this deeper meaning. It implies a specific way of making money, a way that deliberately avoids unnecessary risk.
Making money without taking risk? That sounds almost too good to be true. Isn't risk just part of the deal if you want high returns?
For most people, yeah, that's the conventional wisdom. Risk and reward go hand in hand. But the whole point of the Dhandho approach, and you see this in value investing too, is to actively try and break that link.
Ah, okay, so like value investing, where the first rule is don't lose money, protect your downside.
Exactly the same mindset.
Yeah.
Find that margin of safety. Dhandho just applies that thinking beyond just stock prices, applies it to the actual business strategy, how you use your capital, everything. The simplest way to put it, the formula is heads I win, tails I don't lose much.
Heads I win, tails I don't lose much. I like that, very clear.
That's the essence of it.
Okay, let's test this. Bill Gates, Microsoft. We think of tech giants, we think huge investment, venture capital, big risks, right? Starting Microsoft couldn't have been low risk.
You'd think so, wouldn't you? But the sources point out something kind of staggering. The total actual cash, the capital invested in Microsoft from day one until now, it's less than $50,000.
Wait, 50,000 total? How is that even possible for a company like Microsoft? That sounds incredibly low risk, financially speaking.
It was. See, there's a difference between financial risk and uncertainty. Gates faced huge uncertainty. Would people buy his software? Would it work? Big questions. But the actual financial risk, the money he could lose, tiny. He hadn't sunk millions into it.
Okay, fair point on the capital. But what about personal risk? He dropped out of Harvard. Surely that's a massive gamble.
Well, let's look at it through the Dhandho lens. At that moment, as a Harvard freshman, what was his downside really? If Microsoft completely failed,
He goes back to Harvard.
exactly, he could likely just re-enroll, finish his degree, and probably end up on a similar career path anyway. His opportunity cost was mainly time, not a devastating financial loss.
Yeah.
So from that perspective, it was kind of a free shot at enormous upside, almost no real lasting downside if it didn't pan out.
A free shot. Okay, I can see that for software. But what about something really capital heavy, like starting an airline? Sir Richard Branson, Virgin Atlantic, you need jumbo jets. That costs hundreds of millions. How on earth could that be low risk?
Yeah, the airline example seems like the ultimate counter-argument, right? Branson's often painted as this huge risk-taker.
Definitely.
But again, the Dhandho approach wasn't about avoiding the need for a plane. It was about avoiding the financial risk of acquiring one. He didn't just stump up cash, he got creative.
How?
He contacted Boeing. They had an old jumbo jet just sitting around, not being used. They agreed to lease it to him.
Okay, leasing helps, but it's still a huge financial commitment if the airline goes bust.
But think about the structure. For Boeing, the risk was actually pretty low. If Virgin missed payments, Boeing just took their plane back. They still own the asset.
Got it. So Boeing was covered. What about Branson?
This is the clever part. He engineered the cash flow. Virgin pre-sold all the seats on its flights, like 4 months in advance. So they had cash coming in long before the major expenses were due.
What expenses?
Well, fuel, for instance. That wasn't paid until 30 days after the flight landed. And the plane lease payment, also due after the flight.
Wow. So the customer's money paid for the fuel and the lease before Virgin even had to shell out.
You got it. The operational cash cycle basically funded the launch. Virgin Atlantic effectively got off the ground with zero, or very close to zero, net capital investment from Branson himself at the start. It was financial engineering to eliminate the downside. Pure Dhandho.
That's incredibly clever. Okay, another core Dhandho idea feels a bit, well, maybe uncomfortable for some people. The idea of cloning, copying others.
Yeah, we tend to look down on copying, don't we? We celebrate originality, innovation.
Right, being first.
But Pobre argues in the sources, and it's a strong point, that being a great cloner actually puts you way ahead of the game, maybe 90% ahead.
Why? What's the advantage?
You're essentially outsourcing the biggest risks. Think about it. You don't have to spend massively on R&D wondering if an idea will even work. You don't have the risk of market validation proving people want this thing. Someone else already did that hard work.
You just copy them.
You copy the proven concept, but then you focus on better execution. Look at Bill Gates again. Microsoft Word wasn't the first word processor, it copied WordPerfect's concept. Excel wasn't the first spreadsheet, it copied Lotus 123. Gates just made better, more integrated versions.
And Sam Walton, Walmart, he famously said he never had an original idea.
He was a relentless cloner. Walmart basically copied the model of Sears and Kmart, the established players. But Walton obsessed over execution logistics, distribution, cost control. He'd constantly visit competitor stores, figuring out what worked, what didn't, and how to do it cheaper. He took a proven model and just perfected the operations. Lower risk, massive success.
Okay, let's shift to a less glamorous example, but one that really highlights the Dhandho principles in action, the Patel motel strategy.
Right, this is a fantastic case study because it's about applying Dhandho to a regular kind of boring business.
So, set the scene. Who were the Patels in this context?
We're talking about immigrants, many arriving from Uganda in the 1970s after being expelled. They often came to the U.S. with very little, stateless, and without the typical skills for, say, white-collar jobs at the time.
And they got into the motel business. How is that low risk for them?
Through a really smart, disciplined operational model, they'd buy small, maybe struggling motels. And the key step, the Dhandho move, was this. The entire extended family would move in, living in maybe one or two rooms of the motel itself.
Living in the motel.
Yes. And the immediate consequence, they fired all the paid staff.
So we had left the low-risk billionaires. How Dhandho investing flips
Their
the
labor
script.
cost effectively dropped to zero, or near zero.
Yeah.
And that became their huge competitive advantage, their margin of safety.
How so?
Well, think about it. If the motel across the street needs to charge, say, $25 a night to cover payroll and other costs, the Patel-run motel with zero labor costs could charge maybe $19.
And still make a better profit margin.
Exactly. Lower price attracts more guests, so higher occupancy, and better margins, because the biggest operating expense, labor, was gone.
So they weren't innovating in the motel concept, just ruthlessly optimizing the cost structure.
Precisely. They saved the profits, built capital, bought the next motel, did the same thing again. Rinse and repeat.
Yeah.
It's incredible that this relatively small group, maybe at 0.1% of the U.S. population, now controls something like 80% of all motels in the U.S. It's pure Dhandho, sacrificing lifestyle temporarily to eliminate costs and guarantee downside protection.
Okay, this all makes sense for starting businesses, but how does this apply to someone listening right now, maybe someone in a regular 9-to-5 job, thinking about their career, or maybe a side project?
So we had left
Dhandho
the
kind of
low-risk
forces you to reconsider
billionaires.
what risk
How
means.
Dhandho
We
investing
often think
flips
9 to 5
the
is a safe
script.
option, right?
Yeah, stable paycheck, benefits.
But is it really safe? What if the biggest risk is spending your one life doing something that isn't fulfilling? Never, getting your music out, as the source puts it. That's a huge opportunity cost.
So if you have an idea for a startup, the usual advice is save up, quit your job, and go all in. Is that the Dhandho way?
Absolutely not. That's maximizing your financial risk. Quitting the job is the last thing you do, according to this philosophy.
Why? Don't you need to focus?
Focus, yes, but protect your downside first. Most new businesses today don't need massive capital. They need brain power, effort, time. So the Dhandho advice is, don't quit the day job. Why? Because, as Pobre colorfully puts it, some other yo-yo is paying your rent.
Okay, so keep the income stream going. That's your financial safety net.
Exactly. Your downside is covered. Then it's about disciplined time allocation. You need to carve out time, maybe the time you currently spend scrolling social media or watching Netflix, call those the orange blocks, and dedicate that time to your startup idea, the yellow blocks.
And
So we had left the low-risk billionaires. How Dhandho investing flips the script.
And watching that next episode or checking Instagram. If it is, you've got something. You start small, keep the day job paying the bills, and you only scale up or quit when the venture proves itself and can support you. Minimize the financial risk until the uncertainty reduces.
It seems like this whole philosophy, Dhandho, value investing and all, comes back to protecting the downside. Why is that so fundamentally crucial for long-term wealth beyond just not going broke on one venture?
It's crucial because wealth building, real wealth building, relies heavily on the power of compounding. And compounding needs one essential ingredient: time. Uninterrupted time.
And big losses interrupt that compounding.
Exactly. If you take a huge risk and get wiped out, you're back to square one. You've lost not just capital, but years, potentially decades of compounding time. That's the one thing you can never get back. Downside protection is compounding protection. You have to stay in the game.
That makes perfect sense. And speaking of time and compounding, there was that mind-blowing historical example in the sources.
Oh yeah, the Manhattan example. It really drives the point home.
So we had left the low-risk billionaires. How Dhandho investing flips the script.
Seems like a bargain now.
Right. But here's the amazing part. If that $24 had just been invested, say, earning a pretty average 7% per year, what do you think it would be worth by 2023?
Millions. Billions, maybe?
Try $23 trillion.
Trillion. From $24.
$43 trillion. It shows that over very long periods, the starting capital becomes almost insignificant compared to the time and the rate of return.
That's just staggering. It really puts things in perspective.
It gets even wilder. Paybre points out, if someone had invested just 2.3 cents, not dollars, cents 100 years earlier, in 1523, at that same 7%, it also would have grown to $23 trillion by 2023.
2 cents. So the extra century of compounding made up for starting with virtually nothing.
Precisely. It highlights that the length of the runway is often far more powerful than the initial amount you invest, or even hitting super high rates of return year after year. Getting a decent return, avoiding big losses, and just letting it compound for decades. That's the path.
So the big takeaway seems to be focus on not
So we had left the low-risk billionaires. How Dhandho investing flips the script.
Forget the heroic bet the farm narrative.
That sums it up pretty well. It's about low-risk, high-uncertainty bets where you cap your downside.
Okay, so here's the final thought we want to leave you with, something to really mull over based on all this.
If 2 cents invested 500 years ago could grow into $23 trillion just by compounding steadily, what then is the potential compounding value of the next 50 years of your life?